If you are trading the forex market without a trading strategy, or if you're planning on doing so, then I have some bad news for you. You're going to lose your money.
I said, wait a minute. Wait a minute. Wait, first of all, you're not going to speed past that like you didn't just say what you just said.
It might not happen on the same day or week, but you will inevitably lose all your money if you're trading the forex market without a trading strategy. So if you don't want to lose your money or blow any more trading accounts, then you need to watch the entirety of this video. The forex market is an unforgiving, relentless, money-grabbing monster that'll take your money without hesitation, regardless of your financial situation. In its eyes, all traders, regardless of the institution or account balance, are equal. This monster with an insatiable appetite for stop loss, known as the forex market, can be unpredictable at times. However, throughout its centuries-long conquest to satisfy its unquenchable thirst for every last cent within a trader's account, there are several patterns left in its wake as it travels from one support to a resistance, and vice versa. Traders study these patterns and use them as indicators to estimate the probability of the forex market's next move. The keyword just now is probability. Before we go any further, let me tell you that there is no trading strategy out there that has a 100% accuracy. None. All trading strategy tries to do one thing and one thing only: to profit from the forex market's movement by estimating the probability of its future direction. The direction with the higher probability is the direction a trader would open a position in, whether it be long or short. Let's continue. These aforementioned patterns are what traders capitalize on to build their trading strategy. That's because the only thing we know for certain about the forex market is that it will always repeat itself. Therein lie the golden opportunities for success and profit. The repetitive nature creates patterns that a trader would wait for to execute a series of actions to reap their rewards. These actions are what constitute a forex trading strategy. Depending on the pattern that a trader awaits, tells what kind of strategy a trader applies. Some examples of a forex trading strategy are: trend reversal, crossing of moving average, convergence, divergence, break and retest, price action, trend trading. The list goes on. This video will serve as an introduction to some of the most popular forex trading strategies that many traders use to reap profit from the forex market continuously, most of which will be discussed in subsequent videos. Let it be known that whether you're trading forex, binary, indices, or stocks, the information that's provided in this series of videos can be applied to all realms of trading. Forex trading strategies are approaches or plans that traders use to make decisions about buying or selling currency pairs in the foreign exchange, forex market. These strategies aim to capitalize on market movements and fluctuations to generate profits. A well-thought-out trading strategy typically incorporates a combination of analysis, risk management, and specific rules for entering and exiting trades. Also, depending on the longevity of the trade and the time frame that the strategy uses, a trading strategy falls under three categories, namely: scalping. Assuming the trade is in profit, the trades from this type of strategy last from anywhere from a couple of seconds to just a few minutes. That's because the aim is just to make a quick profit and exit the market. Intraday trading, more popularly known as day trading. These trades can last from a few minutes up to a day or two depending on the market's volatility and stop level size. For example, while a scalping strategy may have a take-profit target of 5 to 10 pips, a typical day trading strategy usually has a take-profit level anywhere from 20 to 150 pips target, and sometimes more. Next, there are what we call swing traders. These traders commonly trade once to twice per week. As such, the set and forget concept is a core part of their trading strategy, as their trades would last days to weeks and can sometimes go up to months. There is a fourth category called investors, which is commonly used by banks and large financial institutions and the likes of Warren Buffett. These trades last months and even years before closing. But we will not get into that today, so we are only focusing on the first three categories. Every trading strategy must cover three topics before it can be profitable: analysis of the market, the entry and exit rules, And risk management. There are other topics, depending on your trading strategy, of course, but these are the three basic topics that must be well thought out before moving on to any other. So let's take a brief look at each, so we can understand why every trader needs a trading strategy to be profitable in forex trading. Forex traders often use two primary methods of analysis: technical analysis and fundamental analysis. Technical analysis involves studying historical price data and patterns on charts to identify trends, support and resistance levels, and potential entry and exit points. Fundamental analysis, on the other hand, focuses on economic indicators, geopolitical events, and other macroeconomic factors that can influence currency prices. A robust trading strategy may incorporate elements of both types of analysis to gain a comprehensive understanding of market dynamics. Primarily, technical analysis of any given financial market needs to be done first before doing anything else. Why? That's because technical analysis is analyzing historical price data and volume to forecast future price movements. Traders who utilize technical analysis believe that past price movements and patterns can provide insight into the direction and strength of future price movements. This again reiterates what we said earlier about the repetitive nature of the forex market creating patterns. We are only going to be scratching the surface of technical analysis in this video, because we have explained a lot more about how to do a proper analysis in the forex trading course that we will release once we've hit 10,000 subscribers. So if you are interested in that course, make sure to subscribe to our YouTube channel. Now let's continue. For a better understanding, let's take this example into perspective. A price action trader reviewed the chart as you see here, only to notice that the market seems to be forming a double top price action pattern. Knowing that historical data proves that 8 out of 10 times, a double tops pattern is normally followed by a complete reversal of trend, that trader would then just wait for his confirmation that indicates that his analysis is correct. After said confirmation is received, you will move on to the next step, which is following your entry and exit rules. A trading strategy specifies clear criteria for entering and exiting trades. This could include using specific technical indicators, such as moving averages, oscillators, or Fibonacci retracements to signal entry or exit points, or waiting for particular fundamental developments like economic releases or central bank decisions before initiating trades. By having predefined rules for entry and exit, traders can avoid impulsive decision-making and stick to a disciplined approach. A prime example of an entry and exit rule for price action traders is to wait for the break and retest of a market structure. Wait on a candlestick reversal pattern. This is then followed by a confirmation candlestick, which is normally a larger candle in the desired direction. At the close of said candle, that would be our entry point. As regards our exit, the safest place to put a stop loss would be above the previous swing high. And because risk management is a very important factor, which we will talk about very shortly, we are going to set our take profit level at least 2 times the size of the stop loss. Meaning, if your stop loss is 25 pips, then your take profit should be 50 pips. I'll put a video of how to predict the forex market with price action patterns that shows you how I utilize the very same methods that I'm teaching you in this video to win a trade in real time. So make sure to keep watching. Often you hear people say trading is hard, but that's not entirely true. What makes forex trading difficult is the discipline required to follow your trading rules consistently, even when you are on a losing streak. In other words, the lack of discipline is what causes 96% of traders to fail. Effective risk management is crucial in forex trading to protect capital and minimize losses. A trading strategy typically includes measures such as setting stop-loss orders to limit potential losses on each trade, determining position sizes based on account size and risk tolerance, and using proper leverage levels. By managing risk effectively, traders can withstand market volatility and preserve their trading capital over the long term. About the previous example, setting a take-profit level 2 times the size of your stop-loss means that you have a risk-reward ratio of 1 to 2. This means that you would need to lose 3 times in a row to be in drawdown. Risk management aims to preserve your account for as long as possible, so you can stay in the game to look for more profitable trades. That means risk management is there to prevent you from blowing the account balance on 1 or 2 losing trades. So even if you take a series of losing trades, which is inevitable, you are still able to continue trading because the losing trades only took a small portion of your account balance. The general rule is to only risk 2% of your full balance on any given trade. While 2% risk only means a 4% reward, which could be very insignificant depending on your account balance, I would not recommend risking no more than 5%. Any more than that, you'd be swimming in dangerous waters.
Hello there.
Another topic that should be taken into consideration is the time frame. A lot of people don't know this, but a trading strategy can work in one time frame but fail in another. In addition, the time frame also correlates to a trader's risk tolerance. Forex trading strategies can vary based on the trader's preferred time frame and trading style. Some traders focus on short-term intraday trades, while others prefer longer-term swing or position trades. Additionally, trading strategies may be tailored to specific currency pairs or market conditions. For example, a strategy designed for trending markets may differ from one suited for ranging or consolidating markets. Traders with moderate risk tolerance would be more suited to day trading strategy. This means you would make about 0 to 5 trades per day, depending on market conditions. Traders who prefer low risk with large rewards often opt to swing trading. The traders are very patient and calculative, while traders with a high risk tolerance would feel more comfortable doing scalping. However, they would do a lot more trades compared to the others. They enter the market to make a quick dollar only to exit shortly after, and then repeat the cycle. As such, a scalping trading strategy uses a larger lot size compared to swing and day traders. In summary, a forex trading strategy is a structured framework that guides traders in making informed decisions about buying and selling currencies. By incorporating analysis, risk management, and clear entry and exit rules, traders can increase their chances of success in the forex market. However, it's essential to remember that no strategy guarantees profits, and trading always involves a degree of risk. Now that we've covered the 3 main types of trading strategies, we are going to look at each individually more in depth, along with technical analysis and risk management. So if you are interested in crafting your perfect forex trading strategy and knowing more about how to become a profitable trader, then I implore you to hit that subscribe button, as we do release valuable content like this, so don't miss out.